Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey, everybody. Super excited to introduce everyone to Rodrigo Castellanos. And Rodrigo, I'll give you a second to just say, your name, how we know each other, and what in the world you do today.
Yeah, of course. Well, super excited to be here. Thanks, Craig, for having me on. Hi, everyone. My name is Rodrigo. I am an investment associate at the StepStone group, particularly focused in venture capital and growth equity. Yeah, I'm originally from Mexico City, have been living in the States for a while now, and I had the pleasure of meeting Craig while I was at Wharton. Well, we were classmates, and we were able to collaborate on a couple of things through the private equity and venture capital club. Great program, great resource for me. Definitely, I wouldn't be at my current job or have met Craig, for instance, you, if I hadn't applied and been on the board. So super happy and feeling very lucky that I was able to do that.
I want to wind back the clock like a decade. So you're an undergrad, you're at Georgetown.
Yes.
What did you major in?
It was technically international economics, but that's just
yeah.
In my school, so I went to the School of Foreign Service. They just add international before every major.
Okay.
so just econ.
I was also an econ major, and as a fellow econ major, I know that it is tangential to finance, but it's not quite the same thing. So you somehow managed to wriggle your way into an internship at JP Morgan. Could you just talk a little bit about the group where you interned, and maybe a little bit, as much as you can remember, about what that interview process and prep was like for you?
Yeah, no, certainly. I can even start probably before more than 10 years ago, kind of how I even started applying to schools and what my approach was. And I was, again, to dive a little bit deeper into my background, originally from Mexico City. Through circumstances, my family immigrated to the US. But, it was interesting because both of my parents are college educated, but at the same time, they're college educated in Mexico, right? And it was this mentality of you go to school, and then you get a good job, right? And they're both accountants. Love my parents, by the way, they're great people. But it's definitely what is it? A bird in one hand is better than two in the bush, or something like that. Always not a lot of risk taking. So when I was applying to school, I knew that I wanted to do something in the international relations sphere. I was very much into valuation. And so that's why, and I'm giving this background to get eventually to address your question. But so I applied to school, got to Georgetown, dream school, amazing. And so my first year was really all about just getting the basics down, right? And again, I just didn't know what going to school in the US would be like. So it was, or going to university in the US would be like. So it was kind of a lot of new things coming at me. But at the same time, Georgetown, I think, did a great job of giving folks the opportunity to explore. So I was very focused on my academics the first year, but then going into the second year, those conversations started happening with my family of okay, what do you think? What do you think you're going to do after, And so it started to become I don't know, well, I guess I'll become a diplomat or, work in a think tank or something. And they're like, what's that? Does that even pay the bills? Or you're going to become a government worker? And, I love my wife, who I actually met in school. She's a government worker, but in Mexico, it's well, the government workers are not as, not seen in the same light. So as if you won't go into the private sector. So I started thinking about that. And then, in comes junior year, where I didn't know what consulting was. I didn't know really what investment banking was, certainly not what investment management was, and, alternatives and all that stuff was completely new to me. But the good thing I think about Georgetown was we had a lot of folks come into campus, PwC came in, Deloitte, obviously Goldman Sachs, JP Morgan. So, and these are like words that I kind of knew about, or like kind of knew, what JP Morgan did, but I couldn't tell you really the biggest difference between a stock and a bond really at some point. But it was there, right? And like that's kind of where my classmates were going. And I was like, well, it sounds like it could be an interesting place to spend the summer. So, and I know that sounds like super privileged, and I do want to acknowledge it that it was. But at the same time, I really didn't know what was going on. So I was going to a lot of like info sessions and learning, and I realized quickly that like investment banking wasn't probably going to be my thing, given like almost the second sentence was the hours are horrible. And so with that, I was like, that doesn't sound like I want to do that. But, obviously, like I still tried and I applied, didn't get any internships, but I did get, or any offers, or, even interviews. But I did manage to get an interview with the asset management side. And so when I, was talking to folks, it's like, oh, well, you spend a lot of time. And actually, like, interestingly enough, it was people who had my same background, who had gone to the School of Foreign Service, had done economics, or just hadn't done, business things. So they didn't study finance, they didn't study whatever. Like some of them were French majors, and I was like, you're whatever, sales or trading at Credit Suisse, and you majored in French. It's like, well, tell me about that. Like, how did you make that jump? So I think, for the listeners out there, it's like you have to find, I think, people, it sounds obvious, right? But just like find people who come from your same background, and then try who are in these positions or in these places where you want to be eventually, and like start talking to them first about like what you have in common, but then very much come at it with like kind of a game plan of like, this is the one thing that I want to get out of a conversation with someone. And so I started doing that, and managed to get an internship at JP Morgan, and it was great. It was a ton of fun, very high expectations, high intensity, but I really loved it. It was a great time. Wasn't lucky enough to get a return offer, and that's something we can talk about too, because I think when you're younger, having a setback like that can feel like it's the end of the world, and it certainly did for me, right? But it ended up being okay, later on. So here we are 10, 12 years after. But yeah, anyway, I'll stop there and see if
could you talk a little bit? I think like one of the most intimidating things about big banks globally, and like JP Morgan Chase is like the biggest of all the big banks, is there all of these silos that have all of these names that are hard to, like, the big names are hard to understand, and then you filter down and there are all these groups that do very specific things. So could you just talk a little bit about where within asset management you interned, and like just an overview of the asset management umbrella at a big bank like JPM?
Absolutely, yeah. So broadly speaking, right, you have, well, let's just start with asset management. At JP Morgan, there were two big buckets. It was basically institutional money management. So think about like like the big funds. So kind of like a long only fund, investing only in stocks in the stock market, but it's the JP Morgan, quantum fund or whatever they were called.
Yeah, like these funds are like an insurance company, maybe like if like MetLife is like an insurer and they like have a bunch of positions, like that type of company. Okay.
Exactly. So that's like one silo, and there was a lot of silos, but and that's not where I was. I was at the private bank, actually. So that's I think a little bit easier to conceptualize, and that's why I went into it too. It's wealth management, right? Where the acronyms are going to start rolling in is the ultra high net worth, right? Those were the, I can't remember what it was, but it's like people with a ton of money, like a ton of money, millions and millions. And then you have your high net worths, which I think we said it was like 10 million assets, or like net worth of 10 million or under. And so I was in the private bank.
And 10 million of investable assets too, right? Not just like, you can't count your house towards it. So these are like very wealthy folks that just have like $10 million that they are actively investing, targeting, $500,000 to $1 million just on returns. Like they're just making money on their money as the minimum. Like those are the poorest of the folks you're interacting with.
Yeah. No, totally. And so where I was, and then within that private bank, you have the bankers. So those are like the relationship managers. They deal with the clients, show them the investment opportunities. And then you have a lot of people, basically like the support, right? And so I was part of that support team. And I was in a place called GIO. And again, with the acronyms, that stands for Global Investment Opportunities Group. And what we did and how we functioned, it was basically like an in-house hedge fund only for private bank clients. And I remember vividly, like, when I was going through my interviews, I was like, I'm from Mexico City, I'm from Mexico, I was super interested in LATAM. And so I thought I was going to be placed in one of the covering teams with LATAM and, interacting with clients. And then I get put in this kind of like, in-house hedge fund. I was like what happens? And it's one of those like serendipitous things of like, it kind of just happened. Like I asked around, it's like, yeah, we don't know. They just needed someone here and you got here and that's what it was. So, but it ended up being great because, as Craig, like hedge funds have the ability to invest in anything, right? So that meant that I had exposure to everything that I didn't even know existed, right? So not only stocks, not only bonds, but now also you started getting into like currencies. Like we would create currency, what we call products, or like trading strategies for folks. There wasn't, if the listeners here probably going to be like, wow, this guy's so old. There weren't cryptocurrencies back then. Like, I mean, there were, but it wasn't an investable asset.
Yeah, just Satoshi, not all these ICOs and stuff.
Exactly. Yeah.
And by the way, like the term like product of like what is a financial product, I personally found so confusing and complicated because it's like, what do you mean? There's no product. Like you don't sell like a thing. But taking a step back, basically like the high level on like financial engineering is you have investors that want some level of expected return, and there's some level of risk that they're willing to tolerate to try to achieve that expected level of return. And products are basically instruments with some expected return and some expected risk that might focus on a particular thing. So like you might not just want a 10% return, high risk product, but you might want a product with those characteristics that is focused on US equities, which might be a market that you know and care about, or focused specifically on commodities trading and like the price of like aluminum versus the price of copper type of stuff.
Right. And so that was, and I had no idea what any of that meant.
Yeah.
Right? I still kind of don't. But yeah, no, it was great to be in that group for 2 months. I learned a ton. Like, it's just like a really interesting part of finance, and I think that's also something that I, throughout my career, I've seen like there's so much to the financial services industry, and there's more being added right now with the advent of artificial intelligence, and you have the robo advisors, and that's like another whole new thing that can revolutionize the market, but also like it means also new opportunities, right? Maybe before there was only like a money manager, you would be a trader or something like that, but now you might even be like a coder at a hedge fund or something, and that's a complete thing, and you work in finance. So I just think it's really interesting and exciting, and definitely very different from where it was 10 years ago.
Yeah. So now let's fast forward a little bit. So you don't get the return offer.
Yeah.
And there's this feeling of overwhelming doom and gloom and devastation. And you turned it around just like, everybody eventually turns it around. Tell me maybe a little bit about where you end up working for full time, but focus more on how you positioned yourself coming out of not getting an offer, which is like, it's something that a lot of people experience. Like what did you do to try to say like, hey, I'll be great at this job, even though like whatever dynamics happened over the summer?
No, absolutely. And I think that this is also something that I've learned. I obviously learned it the hard way. And looking at other folks and speaking to them, it's like, if stuff is not clicking, it could be because of two things, right? It could be because, you don't understand it, but you're capable of, or because it's just not kind of, it's not how you think. And let me be careful here, but it's like, in the trading floor, you have to be a really fast thinker, and you have to be kind of very intuitive. And there's not a lot of time to like sit down and think about a problem and think about solutions, or just like, start calling people and like, okay, what do you think about this trade? No, you have to have like a real instinct for it, which is something that I didn't have. And I started realizing that, like, I wasn't putting in trades or anything when I was an intern, but it was just kind of the job and the atmosphere, and I just felt out of place. So coming out after not getting an offer, obviously I was very disappointed. But I think quickly I was like, okay, maybe that wasn't the place. Maybe it's a good thing that I didn't get that offer. And so now let's look at what else there is. And so the first step was going to the career center, and again, like, shout out to the folks at Georgetown who were really helpful in like understanding where I was. And to your point, like, tons of people don't get offers, right? And so there's this great many people, students, who come back after their junior summer and they're like, well, I didn't get an offer, what now? And so you start re-recruiting. And so now you start realizing, right, that, oh, I'm not the only one. Like, there's actually a lot of people, or some people did get offers, but they want to re-recruit or whatever. And that's completely fine. And so, but again, like, no one tells you, right? And you, hopefully this is a theme of like, it sucks because you think you're the only one, but actually once you step back and start asking around, it's like, oh no, there's actually a lot of people who are in a similar situation, and I can become part of like their tribe, right? And so that's what I did. I started figuring out like, hey, you want to, like, with my peers, you want to, set up 30 minutes to do a mock interview. Yeah, let's do it. And like, that kind of bonds. I bonded with people in that way because we were all trying to work towards the same thing. So anyway, long story short, I started doing that and just applying. And I knew I wanted to stay in finance, right? There's like kind of two options for me when I was a junior. It was like consulting or finance. And I knew consulting, man, that sounds like you always, again, have to be on the clock, and you travel a lot, and that's cool, but it's apparently like to not great places. So I don't know, it just didn't sound like my cup of tea. It was like, I tried finance, I actually really like it. There's a lot of smart people. That's something that really interested in me. And it's that it's a lot. I mean, there's a lot of people, smart people everywhere, but I just kind of felt more attracted to that. And so I started applying, and then I found this, and I applied to, again, investment banking jobs. I applied to equities, funds, anything really that was finance related. I was like, okay, let me just throw my hat in there. But long story short, I saw this job posting for an alternative asset manager. And I knew what that meant because when I was in my internship at JP Morgan, we were putting some of our clients in private equity funds. And I was like, what is that? Right. And so I remember one time I had to like go through a subscription document, like a subscription, the subdocs, what we call them, where you have an investor, they fill them out. And that's basically like the agreement, the contract between the investor and the private equity fund that they're going to be, an investor in the fund. And so I knew what private equity kind of was. And obviously I started doing research but and then it was this word, again, new acronyms, new words, a fund of funds. It's like, well, what's that?
Yeah. So let's talk about that, because this is so critical to the plumbing of like how investments work. Let's talk about a fund first before we talk about fund of funds. What's an example of a fund? How's it organized? What do they do?
Yeah. Great example. Blackstone. Blackstone's a publicly traded company. You can go look them up, look up their 10K. They're a private equity company. And what they do is that they set up these vehicles or pools of money, essentially, right? Where you have, what's called a general partner. In this case, the general partner is the person or group of people who manage a fund and get to make the decisions of where to invest the fund. The other side of that coin are the limited partners. So that could be Craig, you, me, whomever is on the call, right? We pool our money and we commit to the fund. So we say we are committing $10 million to Blackstone 15, whatever it is. And Blackstone 15 now has a commitment for us for 15 million. Blackstone 15's job is to go out there and find interesting investment opportunities in whatever strategy that they're pursuing.
Yeah. So I, as a person with money, or as a company with money, or an institution, I say, hey, like, I'm looking for financial products that'll help me generate a return. I go find a fund, or I go find a manager of a fund, and they're happy to take my money because they're going to earn fees off of my money. And I'm happy to find them if I think they're a smart investor because they're going to earn me money. Okay, so that's a fund. Now let's talk about fund of funds. Where do they come in? What does that look like?
What are those? Yeah, so a fund of funds is a private equity fund that, instead of investing in companies like Blackstone 15 would, or buildings like Blackstone Real Estate Partners 15 would, they instead invest in other funds. So this is where it starts to get kind of interesting, right? And again, to your point about the financial engineering, this is a great example of that. So I worked for a fund of fund for a while, where my job as an analyst at the fund of fund was to evaluate other private equity funds and firms, and then assess whether they would be an interesting opportunity for us to commit to them. So I would then be assessing, for instance, Blackstone Private Equity 15. Okay, what, are they a compelling team? Are they, what has their track record been? All of that stuff. And then making a decision to commit, again, 10 million or however much capital is on hand to these funds.
And that I think is a great setup, because I think now listeners can start to have a really cohesive understanding of all of the tiers of the financial system, because sometimes it's just people with a brokerage account buying Tesla stock, but increasingly more and more of the value of, US companies and like US economic output is in these privately owned companies, which are basically companies that you can't just go buy stock on. This can range from everything to like a pizza place that, like, yeah, of course they're like not on the New York Stock Exchange, to increasingly massive companies like OpenAI, like has this partnership with Microsoft. You can't just go buy OpenAI stock. They're privately traded. And so in this ecosystem, the value is getting created by companies, right? Like there is an entrepreneur, there's a CEO that like is building a business that is profitable. The next level of value chain would be the fund manager. So this would be someone who knows how to value these companies. And like, if you work in private equity, the core skill set is finding companies and knowing what they're worth, and knowing how to bid for them. And then a little bit, once you own it, trying to help the company perform well. But that's not kind of like the tip, the whatever, like the whatever end of the iceberg they belong in, because there's a level below that, which is anybody could just say, hey, like, I'm going to start a fund and I'm going to invest in companies. But there's a question of like, are you allocating capital to the right managers? Are the people who are going to be the most value added investors the ones who are actually getting capital to put money to work in whatever, industry or sub-industry or thesis they're pursuing? And so that's where the fund of funds come in. Like the core competency of a fund of fund manager is, you might go to, the sovereign wealth fund of Singapore, or you might go to a large insurance company or a very rich person, and just like somebody who has money and they're like, but I don't know, like I want to do like private equity stuff. That person might not be the best selector of the managers. And so it's basically hiring someone to look at the range of all the funds that exist in the world and figure out who are the best of the best, and then help them convince that investor to take the money too. Like that's the other element of this, right, is that like an investor might say like, I'm full, I don't want your money, or whatever.
Yeah, no, absolutely. And I think that's also another distinction, right? Because now we're talking about private markets. If you contrast it with the public markets, like there's no reason why you can't buy some stock in Tesla. Like if you like you really can just open your brokerage account and say yes, buy, boom, click.
Yeah, because they have hundreds of millions of shares, and at any given point in time, some number of those people are willing to sell to you at the market price.
Exactly. But in private markets, it doesn't work like that, right? It's the illiquidity. So I can't go to Blackstone, meet right now, and say, I want to commit $1,500 to your fund. They're like, well, you can't do that. Like, you're not an accredited investor. Your net worth is not high enough. So, but okay, that's me, just an individual. But then think about like even really high net worth individuals can't even access those funds, the Blackstones of the world or other funds out there, right? So that's where kind of the fund of funds model works. It in a way gives folks access to these vehicles in a way that's a little bit easier to do, right? They don't have to go to they don't have to go to like 15 different firms. They can just go to one firm and then get exposure to those 15 firms.
Yeah. So let's fast forward a little bit. You've done many things in your early but already illustrious career. So obviously, we've talked about a couple of them, but you made your way to Wharton for the MBA, which is where we know each other. But now you work at StepStone. So tell me a little bit about what your day-to-day looks like, and we'll go from there.
Yeah. So my day-to-day, I work in the VC and growth equity team, where we invest both in funds, in venture capital and growth equity funds. So we're limited partners in those. We also invest in startups, going from startups looking to raise their Series B, Series C, all the way to almost pre-IPO, like Series E or whatever. Think about like Stripe is a great example, right? Company.
Okay, so Stripe probably, I don't know what their valuation is, but order of magnitude $100 billion, like big. Not all Series E companies are Stripe big. But tell me a little, like, what's an example of like what like a Series B company would be like?
Yeah, so we're looking at a valuation anywhere from like maybe 150 to 250, $300 million. They already have a product. Hopefully they're generating some revenue. But really we come in and we're what we call like scale up capital, right? We want to help the company grow, acquire more customers, sell newer products, hire more people. So that's where we come in, right? And I think that's a little bit different from like what a lot of folks think about when they think about venture capital, which is like finding, the next Facebook before it's Facebook, before even there's like really any users or anything. That's venture capital. And yes, that is a big portion of venture capital, but VC has started to kind of expand a lot more. And, we can talk about all of this for hours.
Yeah. And so in like these like Series B, Series C companies, what percentage of these companies that you're looking at are actually profitable today? Or at the time you're investing? Very
few, like maybe 10%.
So for listeners who've already like heard a little bit just conceptually how to think about valuation, how to project this stuff, pretty much everybody is familiar with like public companies. It's like, okay, they're profitable. I know they're going to be profitable in the future. And it's just like, how do I figure that out? So you can't really run a PE ratio on an unprofitable business. So like what types of frameworks would you use, or like how would you think about valuing an unprofitable business, and why is it worth anything? Like, why isn't it like negative money?
Yeah, no, absolutely great question. So I'll address your first question first. How do you go about valuing a company that's not profitable yet? Well, first off, you need to have a good sense of what the company does, is it providing value to its customers? And it might not be profitable right now, but what is its margin, right? Like how much of the revenues that they're generating are they actually like after costs? What is that difference, right? What is their gross margin looking like? Usually when we invest in companies, or most of the times when we invest in companies, my firm, there's already a gross margin. And we invest in a lot of software businesses. Those are very low cost businesses, which means a higher gross margin. And so we like that, right? Ideally, we would love to see a company in the 70% to 85% gross margin. Now, they're not profitable, by the way. They still have to pay out like their employees. They still have to pay, the bills, marketing, all that, SG&A. And so once you get down to like the end of the income statement, that number is still negative, but they are above a certain line, revenue generating, gross profit positive.
Yeah. So they have sales, they make a product that people want, and and that because people are paying them for it. And then you're really focused on this gross margin in particular, like not profit margin, not EBITDA margin, it's gross margin. Because if it's not profitable today, that means their revenue is not covering all of their costs. But as you roll forward and think about the future, in a world where you believe in growth of this business, their gross profit will improve, and it will improve quickly relative to revenue because the gross margin is so high. So for every dollar of revenue growth they're generating, that's 85 cents of gross profit growth. And so the idea is that growth will occur faster than their other costs will grow. And that's the math that says it's not profitable today, but it's this line that moves up in some linear or nonlinear, hopefully exponential function.
Yeah, exactly. And so like to really address your question, how do we think about it? Well, we think about it, how do we evaluate companies? We evaluate them in terms of gross margin, but then also in terms of market, right? Is this a market that can sustain a big enough company, a large enough company? And then can this company be a winner in that space? And that's when it gets much more qualitative rather than quantitative.
Can you give an example, or like how do you even like begin to think about something like that?
Yeah, that's where getting to know the founders is really important. Craig, you were an entrepreneur yourself, so don't have to tell you this, but for everyone else on the call, right? Like having faith in the entrepreneur and really believing in their vision is kind of one of the most important things that we can do. And how we go about doing that is reference calls, right? So we talk to everyone or try to talk to everyone who's worked with this person. Hopefully this entrepreneur has experience in the market where they're developing their solution, their company. Hopefully they have an edge. And usually founders who succeed are very tenacious. They are very driven to solve whatever problem they're trying to solve. So that's kind of what we do to evaluate founders. And then I think that the other thing is also we do a lot of references with other investors. And sometimes they're already, usually by the time that we invest, there's already like a seed investor in the company. And so we call them up and say like, hey, how's this person? What do you think about the company? And that's when you have to be careful, because obviously if an investor is already invested in the company, they're going to be like, oh, it's amazing, it's great, it's please come in, save, yep. New funding round, give them more runway. But we have other ways of like triangulating and making sure that the company and the product that they're building is or can win in the space.
As you think about kind of not only your kind of like core skill sets and competencies, but also your interests and like the type of work that you gravitate towards, there's a lot that goes into your job, right? Like there's a networking component, a relationship building component. There's a quantitative component. There is a like business logic and like market landscaping, like SWOT analysis component. for someone who's wondering, is kind of like this combination direct investing fund of fund role, like, is this right for me? Is there any skill set that you find is particularly important or that you spend a particularly large amount of your time working on? Or is it just kind of like, is the generalist ethos grounded in deep financial modeling experience? Like, is that kind of like the core skill set?
Yeah, no, that's super. Yeah, well, I could talk about this for hours. But I think what I gravitate towards the most in my job are the opportunities where there's an untapped kind of potential. So like everyone right now is talking about AI, right? And so many people are fishing in that pond. 3, 4, 5 years ago is all about Web3. Everyone's fishing there. But what about like trucking, for instance, right? Like no one's really thinking about trucking, or like what kinds of technology solutions a trucking company might want. And I can bet you that there's 1 or 2 or 3 of really interesting companies and driven founders that are really thinking hard about the trucking space and what kind of solutions they want. That's what I really like. And in my job, that's what I'm paid to do. I'm paid to, because we are generalists, right? We kind of have a free range of like to look at everything. So I'm not a healthcare investor. I'm not a software only investor. I'm just an investor. And I think that's something that I like. I like being a generalist. I like looking at a healthcare deal one day. Then the next day, let's look at, a grocery delivery business. And the next day, let's look at, mobility company in Asia. And because that's the other thing about my role is that we're global. So that's why I chose this job, really, because I had the opportunity to look at a lot of things, right? And I'm only a year into the job, but I can already tell you, like, I'm starting to develop I'm starting to know what I like. And I always tell people this whenever they ask me, like, in business school, why should I go to business school? It's like, well, business school, you're paying someone else to teach you, right? You're paying to learn. But now I'm getting paid to learn. And that's kind of the best part. And if folks are in a place where they're getting, like, literally in a job, in a role where they're getting paid to learn stuff that they care about, I think that's absolutely like one of the best predictors of success and fulfillment. So that's really what I enjoy about my work.
So it's really about learning how to learn. And so that is to say, if you want to spike in one particular category and you want to lean into that and be like at the cutting edge of that one thing, maybe this isn't the right career path for you. But if you just enjoy learning new stuff, if you love to read, if you love research, like, that starts to be the type of archetype of exactly who this is for.
Yeah, absolutely. Absolutely. Because you have to be conversational in a lot of things, right? Like I need, in my role, if I'm talking to founders, if I'm talking to fund managers, right? I need to know, like, have an idea of what an large language model means. Like, what does that mean, right? But I also need to know what customer acquisition is for a business that's in grocery delivery. Like, what do those costs look like? What's the payback period? And that's what I enjoy. And I think now I'm starting again to gravitate towards certain things, certain geographies. But again, I'm getting paid to learn what I like instead of me having to figure out the hard way of, like, because you could go to a healthcare business or a healthcare firm and be a healthcare investor and be like, wow, this actually, like, I'm not really that passionate about it. And I see a lot of, folks our age kind of start to realize that, or maybe that's why they went to business school too. It's like, this is kind of where I ended up, but now I'm ready for a change. So that's why I'm going to business school, or that's why I'm, taking a little bit of time and figuring out what I want to do. But yeah.
Last question, and I think this is going to be one that folks are going to be really interested in, which is, let's say you found a company that hits all the high notes. It's in a sector that you like, big addressable market, high margin, early evidence of being fast growing, and we can get a conviction that it will continue to be fast growing. How do you put a dollar value on something like that? And I guess as a growth investor, it's not just what the valuation is, but how much of a stake you want to take, or or the entrepreneur will let you take. How do you think about that, or just like what are some heuristics that you might use to start answering a problem like that?
Yeah. Well, lucky for me, and this is also why I like being a little bit more on the growth side or looking at more mature companies. You usually have revenues. They might not be cash flow positive or anything like that, but there's a little bit more meat to chew on, financially speaking. So you can start to model out, make assumptions and say, okay, like in 10 or not 10 years, but like in 5 years, where's this company going to be? So you do that. You also start thinking about exit, right? Liquidity. So who might be an acquirer of this company? Is it going to be a strategic company or a if I'm looking at a pharma deal, is it going to be Eli Lilly or Pfizer who acquire this company? If I'm looking at let's say a transportation deal, right? Is Tesla going to buy this software or something like that? Or does it have the potential to go public? And it seemed, for 5 years, 5 years ago or so, that everyone was going public. SPACs were all the rage. And now, the past year or so, it's been the complete opposite. No one's going public. But that's the other kind of option for liquidity. So it'd be, I look at really, do a deeper dive on the business itself, start to model it out, make some assumptions about growth, about margins, etc. Think about exit liquidity, and then as another portion of that, or another part of that, is what are the publicly traded companies that are in this space? What are they looking like? So you're talking about PE ratios. Something that we look at a lot is forward revenue multiples, or forward, and that's what that means is you take the valuation of a company, of a public company, and then there are estimates that the analysts in the street come up with for what the revenue is going to look like next year. So you basically are saying, it's kind of like a PE ratio, it's a valuation ratio, right? You're saying it's a 20 times, this business is worth 20 times its revenue next year. So we look at a lot of those, and then we come up with an average, right? And then we stick it into the model, and okay, what does it say? What's the end of day, equity valuation for this company? If it's something, that meets our underwriting, meets our criteria, then that's the go forward light. If it doesn't, well, it might not right now, or maybe we have to revisit some assumptions, and then, make sure that we're really understanding the business and the sector, and then the exit potential. So
Which is
that's a little bit of how we think about it.
Which is a fascinatingly different approach from public market investing in a lot of ways, because if you're looking at a public stock, you're kind of doing forward logic where what they have today, you'll build a cash flow projection, and that's your value. And basically you're comparing what you think the value of this company is today against what other people think the value of this company is today. Like, everyone's looking at value today, and if you're buying a publicly available stock, your opinion is that, or your analysis shows that this company is worth more than other people think that it's worth. And in private markets, particularly in VC and in growth equity, there's this funny recursive logic where you're kind of taking for granted, or taken as given, there is a big liquid public market out there for companies that sort of look like bigger future versions of what this company could look like. I'm just going to take that market price. I'm not going to take a view on that. That's just what people think these companies are worth. I know what we have today. And so the first step is, can I get conviction that we will look something like that in the future? You can look at how the market will in the future value this future thing. And then you can work your way backwards to say, okay, at what level do I have to come in today to earn a satisfactory return that meets my return threshold and underwriting standards, such that if I'm right, I generate that return because this company will look like these other things. Which gets to like the big VC downturn that's been so fascinating, is like, on the one hand, there's so much dry powder, right? There's like all this like venture capital money. On the other hand, when public market valuations for fast growing, recently IPO'd companies dries up, or when the IPO market dries up and it's harder for companies to go public, valuations are coming down for two reasons. One, because public companies, like these reference benchmarks, are coming down. And two, a delay, especially for like later stage VC, like companies that like maybe would have gone public this year, but now have to wait a year. The investors today have to delay their expectations of when it's going to achieve that value. And so you have to further discount the value today because there's more time between now and then.
Exactly.
And there's also uncertainty too. There's like this question of like, well, we don't know if these multiples are going to be sustainable. Because it's hard to project in the future whether multiples will come up or come down. People tend to just look at like what the forward revenue multiples are today, right? Which is like sort of like a complicated logic, but
no, it should always be, what are the forward multiples going to be at the time of exit?
Yeah,
which makes it incredibly difficult because there's no way to know that.
Yeah.
If someone does, though.
It would be great if you know that, but absent that information, people just tend to look at what the forward multiples are today as a proxy for like, well, I don't know if it'll be higher or lower, but this is where it is. And so this is where we are.
Yeah.
Rodrigo, thank you so much for taking the time. I really appreciate it.
Of course. Happy. Hopefully that was succinct and, it helps people out there. And happy to do this. And Craig, you have my contact info, so don't hesitate.
That does it for today's episode. Thank you so much for listening, and remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.